You've probably heard the terms bull market and bear market in the news, but if you're not already investing, it can feel like background noise. What do they really mean, and why should you care? A bull market is when the value of investments, like company shares, rises over a period of time. There's confidence in the economy, people are spending more, companies are making profits, and investors feel optimistic. A bear market, on the other hand, is when prices fall sharply, usually by 20% or more, and stay low for a while. People start feeling uncertain, they may sell off their investments, and overall confidence drops. These aren't just labels, they affect real-life things like how your pension is growing, what happens to your savings in a stocks and shares ISA, or how safe it feels to put money into the market. Let's take a closer look at how each one works. A bull market doesn't happen overnight. Markets move based on how people feel about the future. In a bull market, people are feeling confident, the economy is growing, more people are at work, companies are making money, and because investors feel positive, they're willing to buy more shares. That pushes prices even higher. A good example is the period after the 2008 financial crash. Between 2009 and early 2020, global stock markets had one of their longest bull runs. The US market nearly quadrupled in value, and the UK market, though slower, grew steadily too. If you'd invested £5,000 in a global index fund in 2010 and left it alone, it could have grown to over £10,000 by 2020, even after fees. An index fund is a way to invest in lots of companies at once, rather than picking individual stocks. Now let's talk about bear markets. These usually show up when there's economic trouble, like a recession, job losses, or major uncertainty. Prices fall, investors worry, and people start pulling money out. That can lead to more selling, which brings prices down further. A real example is what happened in early 2020. When the COVID-19 pandemic hit, markets dropped fast. The FTSE 100 fell over 30% in just a few weeks. That was a bear market. People were unsure about the future, businesses closed, and the economy paused. But here's what's important. Even though it felt scary, that bear market didn't last forever. Markets started to recover within months. So why does this matter to someone just starting out? Because if you're investing, whether through a workplace retirement plan, a brokerage account, or an investing app, you're participating in the market. When it's going up, your money is growing. When it dips, it might shrink for a while. But these ups and downs are part of the cycle. They're normal. And over the long term, 5, 10, even 20 years, markets have historically recovered and moved forward. Let's bring it closer to home. Say you invest £100 a month into a stocks and shares ISA. If you start in a bull market, your account grows quickly, feels great. But if you start during a bear market, it can feel like you're losing money. That's when many people panic and stop. But here's what most beginners don't realize. Investing during a bear market often means you're buying when prices are low. That can lead to bigger gains later once the market recovers. It's like getting shares on sale. Even within bull markets, there are still dips. And even in bear markets, there can be short bursts of growth. So don't try to guess the perfect time to invest. Focus instead on staying consistent. Also, spreading your money across different types of investments, called diversification, can help smooth out the ride and reduce risk. Think of bull and bear markets like tides. Bulls are the rising tide that lifts your boat. Bears are the low tide when everything looks stranded. But the sea always comes back in. If you step back and give it time, the overall historic trend for stock markets has been upward. So when you hear bull or bear, don't think of wild animals. Think of a long journey with hills and dips. Your job isn't to guess the next turn, it's to stay on the path. Bull markets feel exciting, bear markets feel uncomfortable, but both are part of the process. The more you understand that, the more confident and steady you'll feel as an investor, and that's the real power, knowing how the market moves so it doesn't move you. And remember, past performance doesn't guarantee future results, but understanding the patterns can help you stay the course. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.